Hi, I'm DiMarco. I'm a Naples, Florida realtor, and this is your December of 2023 Naples, Florida real estate market update. I want to note that I've been investing in real estate since 2004, and I was first licensed as a Florida real estate agent in 2005. And I don't say this to impress you, but rather to impress upon you that I did live through the real estate market crash in 2008. And what I'm seeing is a lot of really spooky parallels to that. But let's go ahead and jump right into the actual numbers, which is always my focus. So here, this report will be on my website, naplesed.com. There will be a link in the video description where you can download the PDF of this, get access to real-time charts for the Naples housing market, and all kinds of other great information. So please check it out when you have a chance. Here we go. As we look at where the market's going, I want to keep in mind that this is going to be a supply and demand issue. So the first thing we're going to look at is a supply indicator, which is the months of inventory up about 12.5% just since October. Here, list to sold price ratio remains at 99.6%, but I'll tell you that's very misleading because when I log into my MLS, what I'm seeing, my hot sheet changes in the last 7 days, 850 properties that have had price drops with 100 that have had price increases. So basically a 1-to-8 ratio. And what this list to sold price is reflecting is if I overprice the property, and which I don't overprice properties, but if a property was overpriced and I needed to do 2 or 3 price drops, and then on the third price drop, finally, I lowered it enough to where people took it, that's still going to be reflected in that. So that's a very misleading kind of number. And that number also doesn't take into account seller concessions, which are becoming more and more frequent as we shift to a buyer's market. So when the seller's covering closing costs, mortgage buy down point, more repair, or any kind of concession, that is also not reflected in that artificially high list to sold price ratio. And we're going to see that as we progress through the numbers here. All right, so the median days on the market, relatively insignificant change, says down 5% month over month at 38 days. And the median sold price is showing a 2% month over month drop, which once again to me is pretty much a flat market. And here we begin to actually see with the chart what's really going on here. All right, so this is their median estimated property value. I'm not super huge on this number. I don't read too much into it, but what I'll just draw your attention to are the historical trends on it. Here we can see where the '08 crash happened, where in Naples, prices fell from 282.5 down to 149.2 in 2 years, less than 2 years. And then where they started to correct upwards again, that was a great time to be investing. I had DiMarco Realty back then, and we were grabbing stuff up cash and making a killing. And that's what I'm preparing for. I am not sure if we're going to see a drop that significant as what we're seeing here on the chart, but I do think we're going to see a significant drop in the next 1 to 2 years that will create a lot of great opportunities for investors and buyers to sit on the sideline with some cash. All right, so here we can see the madness started really at late 2020 with the COVID boom. And we watched as home prices from, just look at this, Naples, March of 2020, home prices averaged at 349,000. And then we get up to April of this year and 639,000. That's an insane inflation of prices. And I always like to just point out, I've never seen a more bubble-like form on a real estate graph than this, because if we completed this, then we could see a real drop there. And that's what I'm concerned about. Statistically, I don't want to dwell too much on this, but with the way this is calculated, 2.7% is really a flat number. 2.7% increase. All right, so new listings, aka denial aisle. Here we can see that the median list price is at 750, and I'm gonna really quickly just juxtapose that with the actual median sold price this month, 588,000. So when I say denial aisle, this is what I'm seeing actually out in the field is that sellers have a very different belief on what their property. Look at this median list price, 806,000. So the amount of people are asking has actually gone up 1%, while the number of properties has gone up 12%. So the seller mania, where I think what I'm seeing happen is sellers are saying, wow, the market's still really high. It's really still at its peak. And I think there's starting to be more of a concession that, yeah, this is probably as good as it's going to get. And they're starting to come into the market, but they don't want to budge. I talked to sellers, they're saying, I'm perfectly okay if I'm going to get a better price in a year from now or 2 years from now. I have no problem waiting. Say, I don't really think that's going to be the case. But in either case, I put my money where my mouth is by publishing what I believe, which means I'm not telling sellers and buyers two different things. Everyone can see exactly what I think is going on. And so anyhow, getting back to the new listings coming on at 750. And once again, these aren't the prices. These are the list amounts. So in April, when the market was at its highest, new listings were coming on the market with a median price of 675. And here, as the market has significant slowdown and the sold prices are dropping significantly, new listings are coming in at 750. Number of properties being listed this month down. That could be a holiday slowdown at 6.5%. Median sold price statistically relatively insignificant. Volume up slightly. And let's just jump down to the overall, the aggregate active listings. And these are the November numbers because they get published in early December, which is where we are now. So here on active listings, we can see here that the median list price for actives, once again, way above the reality of what's selling and even what's underpending. So if you're overpriced or even the higher end, anytime we have a market slowdown or a market downturn, it's usually the highest end properties, not necessarily the best location, depending on how you're defining it, but the highest end properties that get hit the worst. So back in 2008, it was Las Vegas, Los Angeles, New York, that got hit the hardest, where smaller towns in Midwestern US didn't get hit as bad. The rising tide lifted all ships and it also dropped all ships. But the higher you boom, the harder you fall. I saw that back in Pinellas County, where I was at the time in Florida, where Clearwater Beach just got decimated. I mean, it was just fire sales left and right. There's even some photos of some developments I was working on back then at that time, and where even inland in Pinellas and Clearwater, Largo, St. Petersburg even didn't get hit quite as bad, although it's still substantial. So here with the median list price, look at this, the number of properties. Overall, the number of listings is up 12% month over month. That supply is coming in. And the only way we're going to be able to stop from a significant downturn is if that demand starts coming in, and that's just not what we're seeing. And if you've been watching my past months' videos or reading my articles, I've been predicting this is a trend that just keeps going. And like I said, I think we're at the top of that roller coaster, and we might be there for a little bit. But I think eventually there's going to be a run on the bank of some magnitude. All right, median days up 1.6% to 62 days, and total dollar volume up almost 15%. So here, when we begin to get a little closer, and once again, when we're looking at the median, this is the median list price of pendings. If we look at the difference between the overall pending listings at 699 and we look at the sold at 588, this was the price that was advertised on the MLS when they went under contract, but we won't know the contract details until they sell, which it's almost always downwards, especially in a market like this. And here, this is a number that stands out to me. Median days in RPR for pending listings up 23.7% month over month. All right, here's the numbers that matter the most, which is the sold listings. And I just want to real quickly look at the difference between the public records and the sold listings on the MLS. Now, one reason the sold public record listings are going to be lower is because that average will have in transactions that are not arm's length, which could be somebody deeding a property over to a spouse or a child or an estate, where the MLS sold listings here is probably a more reliable indicator because they're vetted to make sure they are in some way arm's length transactions that were on the market. But here, sold price down a nominal 2% month over month. Number of sold properties, this is big, down 18.5% month over month. Here, I want to pull up that chart actually. So here, April of 21, 109.91 thousand sold, and here 498 sold. So we're seeing the supply going up, we're seeing the demand crashing. And at this point, I don't know, is that a crash? There's certainly a seasonal thing here in Naples, but you could see the trend here going down more and more. All right, getting back to the actual sold averages. So we're off the market high of 627.5 in April to 588.2 in November. For such a short period of time, once again, pretty good drop. And the total volume, even a more significant number, total volume of sales down 21.5% month over month. Let's look at that chart. Woo! Geez, this is so million. We are pretty close to down from a volume of, geez, what is that? 1.572 billion. We're at very best, this volume, total volume of sales is much closer to a historical norm, but still very concerning. And here, let's look at the inventory again. So 5% supply going up. So this is January of 19 before the COVID boom, 9.68, so almost a 10-month supply. Here at a 5-month supply, we're still at half that, but coming off of less than a 1-month supply, this is real estate takes a little bit of time. And here, once again, just drawing that bubble. You know what? I'm going to draw a bubble, guys. Hold on. All right, so I couldn't resist using the pen at least once. I see this bubble, whether it's concave or convex, depending on whether we're looking at the supply or demand side, but this massive surge we had, and I'm going to be doing a follow-up video on all the other market indicators. Even Redfin here is, I'm going to just throw this up real quick. Redfin is predicting a slight decline. I think it'll be a little bigger than they're predicting in 2024. All right, so wrapping it all up, we've seen the prices start to go down a fairly statistically significant amount for a pretty short period of time. We're seeing it take longer. If we look at the average over a few months, we're seeing it take longer to actually get properties under contract and sold. We're seeing a substantial difference between what properties are listing for and what they're actually getting sold for. We're seeing all of our supply side indicators, and I feel like a broken record. I feel like this is the same conclusion I've been putting out there the last couple videos. All the supply side indicators are increasing, all the demand side indicators are decreasing, And I think as 2024 approaches, that's going to have to mean lower prices, much more of a buyer market shift. I'll probably end up doing a separate video on rental prices, but we're also seeing rental prices start to face quite a bit of downward pressure. So I hold to the school of thought that when it comes to any kind of long-term economic prediction, there's two types of people. There's the type of people that don't know and the type of people that don't know they don't know. Well, what I try to do is I try to look at the trends, and we can make certain inferences from these trends. I am advising people to consider holding some cash if you're an investor, particularly holding some cash on the sidelines, which is against my financial interest because one of my main specialties is packaging investment deals beginning to end for investors. So it's definitely going against my pocketbook. But when we're looking at 10-year treasury bond yields at nearly 5%, where you can safely park your money at a rate that's actually above inflation in a CD, a money market account, or a T-bill, and sit out or wait on the sidelines, because I think it'll be somewhere between a slight downward drop and a major correction. And I tend to favor a more conservative school of investing. Rule number one, don't lose money. Better safe than sorry. I think the smart money, and we are seeing it, all the nation's biggest home investors, BlackRock and some of them, are almost all net sellers at this point. And just in the mania, the cap rates and the yields on investment properties was negative almost across the board. So I'm personally pretty excited about the future prospects for investors, but in the short term, I think there's going to be a lot of pain for people holding equity in real property right now. A lot of sellers are asking me what it means, and what this data means for me is, with the exception of December here being a very slow time in real estate, not a lot of people are shopping and putting contracts on properties on this type of year. When I'm looking at the predictable historical seasonal shifts in home buying and selling at this specific time of year around the holiday season, my recommendation is the best time to sell in the next probably 2 years at least is going to be this January. Best time to buy remains to be seen. I'm guessing it will be at least a year before I would say you're probably going to start seeing appreciating property prices again, at least a year. That's the overall summary of what I see happening here. I do want to note once again that if you've been with me this far, please subscribe. You'll get all of my new content, which I'm trying my best to put a lot of it out there as soon as it's released. Subscribing really helps out my channel. Please go to my website at the link below. You can download this PDF, and you have a really good site that I keep with live indicators directly from the Naples area board of realtors, live charts and everything, where you can get the latest numbers. And with that being said, I'm going to conclude by just taking a minute to actually highlight some of the housing news and other indicators that's behind what I'm suggesting as far as my predictions for the next 1 to 2 years. All right, so I'd be remiss if I didn't end this video by at least touching on interest rates, as we do have industry leaders like Barbara Corcoran. I stand behind my use of air quotes with calling her industry leader, predicting that if we see the Fed lower rates by 2 points or so, what we're going to see is a massive surge of demand come back into the market. All other things being equal, lowering the interest rates will increase the demand side of the equation. It's very hard to predict the Fed. It looks like they're done raising rates, but there's certainly no indication they're getting ready to lower rates. We can see here inflation as of September dropped to 3.7% from 9%. And remember, the Fed's target is getting it down to around 2%. I did recently see Walmart CEO warn of the risk of potential deflation. But from what I gather, most experts that are more astute on Powell's thinking and some of the Fed's activity, that we're likely going to see rates remain pretty flat for the next year, perhaps with some minor decreases being more likely than minor increases. There's been a lot of concern that the higher rates, as they are meant to limit economic growth, are going to lead to higher unemployment. If we see any type of recession starting to become more evident, that the Fed may very well lower rates in response to that. But if the Fed's using that logic, then that means that's more pull on the actual demand side of the equation. Less people with jobs, wages stagnant or decreasing, then that's going to mean that 1 or 2% drop in interest rates is going to maybe be a wash with that little bit of surge in the demand it would cause would be a wash by the demand loss from the softening economy. I feel pretty certain that unless the Fed were to do something manic or start to really drop rates by 3+ percent points, which I have a hard time imagining in the near future, that even if the Fed does lower interest rates, it's not going to be enough to counteract all of the increasing supply side issues that are in the equation. And also, if we're looking at profit to earnings or cost of living indexes, we are at a historical all-time high. And I think that's unnatural and unsustainable. If you've watched just my last month video, I noted that in Naples since 2010, we've seen prices increase by, I believe, over 400%, where inflation was around 37% for that period. This type of mania is never sustainable. It's what Alan Greenspan coined as irrational exuberance. And I think that as the psychology shifts and sellers begin to come to terms with the reality of the situation, we're going to see a pretty significant downward turn. And I don't want to get in over my skis too much into the scope of this video, but I did reference this fact in the housing forecast here. This is from Florida Realtors, which I'm a member of. And the 2024 rental forecast, big surprise, supply up, slower rent growth. Builders got overexcited. Here we can see changing rent versus buy math will create more long-term renters, which has already been happening with home prices at such high PE ratios. There's way less incentive to buy, and that's probably going to remain the case for a while. All right, so before I really go off the rails with getting into the broader market, I sure hope you've enjoyed this video. Once again, if you made it this far, please subscribe to my channel and make sure to check out my website in the link for all that great market stuff I've been telling you about in the video. Thanks again. I'll talk to you soon.